Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I don't want to bash you over the head with this, but I do want to just provide a reminder that I'm hosting a YouTube live event on the 28th of May at 7 p.m. and that you can register for that event. The link is in the show notes. And we're going to cover the 5 common mistakes that people make when buying property, so buying the wrong property, if you like. So if that's of interest, maybe register now. The link is in the show notes. Okay, let's get into today's episode. And over the last 5 years, I've done a bit of work on investment grade apartments and their underperformance, particularly in Melbourne. And I wanted, in light of the Albanese government winning and its proposed initiatives regarding first home buyers, I wanted to revisit that analysis, as well as it's been a little while since then. And I think this is really going to suit anyone that either owns an investment grade apartment in Melbourne or anyone with a budget of less than $1 million will be mostly interested, I think, in today's episode. So I originally produced a report back in October 2020, and I updated that report in 2021, so a year after that. And you'll find a link to that report on the blog on the website. And that report and subsequent update, was a real in-depth assessment of, what's been driving apartment markets and so forth. And the conclusion that I reached was within the next few years, that market will enter into a growth cycle. So I'm not happy to admit it, but of course I'm clearly wrong. It's been almost 5 years since that report, and in fact, apartment markets haven't done very well at all. I mean, they were heavily affected by COVID, of course, particularly through that period of time. They've been heavily affected by, what's been going on in Victoria as well and the sentiment there, neither of which I guess we could have predicted, or I could have predicted back in 2020 when I prepared the report. But anyway, there you are. It is what it is. So I guess when investing and doing this sort of analysis, I'm more than happy to be held to account when I do that analysis. I can look back and go, yeah, I was wrong. But the other thing too is that with mean reversion and market cycles, it's not a perfect science. So we can make a decision about what we think or form a view, but we can't be that arrogant to think that we're going to be definitely right, that, here is the turning point. And also because the bottom of the market or the turning point is almost impossible to pick with foresight. When we're investors in the short term, we've got to leave room for the possibility we'll be in a loss position. So, for example, if I want to go and buy an ETF, I think, let's go and enter this market. I know it might be a long term, and hopefully it is a very long term decision. And so in the long run, I'm working on evidence to demonstrate that returns are going to be great over the longer term. But because I can't pick the bottom of the market, it's entirely possible I make that investment and a year's time I'm in a loss position. Now, that's unavoidable, and that's just a consequence of taking a long-term approach. And it's the same with this sort of analysis as well. So I'm not diminishing. I'm just sort of saying, well, my view hasn't really changed. It's just the timeline hasn't been maybe what I thought it was back in 2020. What I'd like to do now is just go through and update some of that evidence and kind of talk about it. And there's a couple of elements that are all conspiring, I think, at this point, that shows that I think the next growth cycle is probably around the corner. And I appreciate, you can say, well, you said that 5 years ago, Stuart. So I appreciate that could be your thought process as well. Well, let's look at apartment supply. And unfortunately, the Australian Bureau of Statistics don't just give us, high-rise apartments, or at least I couldn't find that data. They really look at houses and then other residential dwellings, which include apartments, units, and townhouses. But really, in terms of value and numbers, apartments are going to make the lion's share of this other residential category, if you like. So around the start of 2019, so this is just before I produced that report, about $2.5 billion of work was commenced per quarter. Now, we've got to be aware this sort of data jumps around a little bit. And what we're looking at is the value of work commenced, because we can look at approvals in terms of what sort of projects were approved, but not all projects that are approved actually go through to being built. So what I'm most interested in to inform me about supply of apartments moving forward is what work has started today. And I know it takes about 18 months or so to complete a project generally. So then it's going to tell me what work started today is what supply will come online or be available within about 18 months, or let's say 1 to 2 years' time. And so back in 19, on average, and again, it's a bit of noisy data, but on average, 2.5 billion were started. Now, if you adjust for inflation, that's really about $3 billion in today's dollars. If you look at where the kind of rolling average is sitting at the moment, it's about $2.2 billion of work commenced. So that's 27% lower than 2019 levels. And even between, say, 2016 and 2018, the levels were much higher, at some point about $3.5 billion. So certainly supply of new build apartments is coming down. Now, the other thing you've got to take into account is what I've talked about here is the value of work commenced, not dwelling numbers or number of apartments. And I would like that data. Unfortunately, they don't publish that data either. But the thing we've got to look at is the cost to build an apartment today compared to 2019 is a lot more, maybe 30 or 40% more. So if we're just looking at the dollar value of construction commenced, actually the likely reduction in actual unit numbers, and that's the most important thing, how many apartments are being built, is likely to be much less than 27%. So the reduction in volume, I think, is more pronounced than what those numbers suggest. But then if you overlay the fact that, population growth has been strong since then, in fact, there's about another 500,000 people in terms of population 2019 versus today. So that's about a 7.5% increase in population and a more than 30% reduction in volume. I mean, you put those two things together, clearly there's a supply shortage. We're building too few apartments that aren't going to accommodate our population growth. Now, this leads me nicely into talking about replacement costs. Now, replacement costs refers to, what would a property cost me today? And it's really a combination of the underlying land value component, plus obviously what it would cost you to build the dwelling. And cost to replace can be used in valuations as a kind of measurement, because normally what you'd want, or normally what you would see is that cost to replace is the same as market value or lower than, and typically isn't generally higher than. And if cost to replace is higher than market value, it's kind of suggesting that, hey, there might be some value in this particular market. So it's been well documented that construction costs have jumped about 30% since the beginning of COVID. And most apartment developers of apartments have said that they really need to charge really 30 or 40% because of higher holding costs, not only just construction costs, compared to projects that they built back in 2020 or before COVID. So it certainly shows that, replacement cost is probably higher than market value in a number of these different apartment markets. So when that happens, two things can occur. Firstly, developers can stop building, because if they feel like, well, it's going to cost me more to build this apartment than the price that I can sell it at, of course, it's not financially viable to do that. And of course, that just adds to more supply shortages. And therefore, it makes those established apartments, those investment grade apartments, more attractive. Alternately, at some point when there is enough demand, developers will be able to pass on the higher costs to new apartment purchases. And when they do that, again, the relative value or price gap between a new apartment and an older style apartment, that'll help that older style apartment. So who knows what will happen in the short run? Maybe there's a supply shortage. Maybe fewer developers will be interested in building residential buildings. But at some point, the cost of a new apartment will need to rise, and that'll drag along the value of older apartments as well. So I want to talk now about the first home buyer stimulus that, as a result of the Albanese government winning the recent federal election. Well, one of their promises was that at the beginning of next year, so 1 January 26, the government will expand its first home guarantee scheme to all buyers. So previously, the scheme was limited to about 35,000 places per year, and they were very quickly sort of snapped up, if you like. Now it's really open to anyone, and they've also lifted the income limits. So you used to be able to access that guarantee scheme. You used to have to be under certain income limits. There's no income limits, but there are sort of price caps. Generally about less than $1 million. So if you're buying property for less than $1 million in most states except Sydney, Sydney's $1.5 million, you can access this government guarantee. And essentially it means that all you need to do is come up with a 5% deposit, You can then go to the bank and you can borrow 95%, and the government will guarantee 15% of that loan. So you avoid mortgage insurance and you really help buyers get into the market sooner because they need less in terms of dollars deposit to be able to buy. Now, the government, by its own projections, expects about 80,000 buyers to take advantage of this, which is around about 11% of all property purchases. But they estimate that there's tends to be about 110 to 130,000 of first home buyers in a normal market. So, of course, it could be more than 80,000 buyers, but it's really going to be a substantial part of the market, and especially a substantial part of the sub $1 million market. And so that's really going to help investment grade apartments because, as I said, the supply of new stock is much lower. Now, developers might start to think, okay, we can get these projects online now with this stimulus, but that takes a bit of time for it to come to fruition. So there's not really a lot of new stock to buy. As a result, there's going to be more first home buyers that are keen and eager to enter into the property market. And it's exactly what we saw back in 07, 08 when Kevin Rudd doubled the first homeowners grant. We saw that sector of the market, that sub-$1 million sector of the market, really benefit from really strong demand. And I expect this is going to be the same with this stimulus as well. And because investment grade apartments, particularly investment grade apartments in Melbourne, fall within this price point, I think they're going to be greatly assisted in terms of we'll see some price growth. So, if you want to buy into that sector, probably doing it before 1 January 26 might be a good idea because you'll have less people to compete with. But if you're a vendor of an apartment, so if you've got an apartment you want to sell, don't sell this year. I think selling next year is probably most likely going to produce a better outcome for you. Now, the other factor we want to talk about is interest rates. Obviously, there's, a substantial expectation that interest rates will be cut. And in fact, as this podcast goes to air, we should have learnt about what the RBA's done in May in terms of interest rate cuts. But when you look at the market's pricing in 4 cuts this year, including whatever cut happened yesterday. So that's a full 1%. NAB is expecting 1.25%. If you look at the longer term bond where bonds are sort of trading at, it's sort of saying maybe 0.75%. So we don't really know what interest rate expectations can change on a dime, by the way. I mean, that's what they are today. But, all we need is some unforeseen news and they can change, either positively or negatively. But essentially, I think if it all plays out, we'll see home loan rates below 5% and investment interest only loans about 5.5%, which relative to long-term interest rates is cheap. That's cheap. That's pretty affordable. And of course, that's going to have a substantial impact on people's borrowing capacity. Now, the people that tend to have the tightest or borrowing capacity that is most sensitive to changes in interest rates are lower income earners, first home buyers, maybe some investors trying to get into the market. So really, again, it's that sub $1 million price point that is most likely going to benefit the most substantially from these interest rate cuts. That is that the interest rate cuts are most likely to have the greatest impact on the level of demand for properties in that sub $1 million price category. Now, the next thing I want to talk about is HEX debt or HELP debt. I think it's called HELP debt now, not HEX, just showing my age there. There's a couple of changes with respect to that. Firstly, the banking regulator wrote to all banks a few months ago to say, look, just be a bit more flexible with HEX debt. So again, this tends to impact first home buyers the most or younger buyers. So if you've got a HEX debt, you could be paying up to 10% of your taxable income in terms of repayments, and that really eats into your borrowing capacity. And so one of the things, the strategies we always like to think about when helping a first home buyer, how do we get rid of the HEX debt to extend their borrowing capacity, if that's like a key thing that we want to do? And so the banking regulator, APRA, has written to all banks saying, just be a bit more flexible. And so typically, if the HEX debt is going to be repaid within the next 12 months, they'll ignore it completely. If it's going to be repaid between 1 and 5 years, they will shade it, so they won't necessarily take in the full commitment. Because don't forget, they're giving you a 30-year loan, and if the HEX debt's only going to be there for the first few years, what's the big deal? If it's not going to be repaid within the next 5 years, then they can't really do anything, or most banks aren't going to do anything. Also, we know that the government's promised to write off 20% of HEX debt balances, as at 1 June this year, so that they'll need to pass that legislation and then backdate the cut. But obviously that'll reduce balances, which will then reduce repayment amounts, and so that'll help first home buyers as well. And then finally, with the government guarantee, now that everyone can access the 5% guarantee, first home buyers could choose to put some of their housing deposit towards reducing their HECS debt. So if you were really keen to increase your borrowing capacity, what you could do is say, okay, I will use some of my savings to repay my HECS debt down to the point where I know I'm going to repay it within the next year. And then if you're going to repay it the next year, the bank can, not all banks, but most banks can then just ignore the repayment. So that's going to directly or materially increase your borrowing capacity. And even if that means now that you've got, a lower deposit, as long as you've still got a 5% deposit, you can access the government guarantee, and then you're not going to pay any higher costs like mortgage insurance or anything like that. So I think the HECS elements, the lower interest rates, and then the government guarantee, they all go to really extending the capacity of people to qualify to get into the market, and then extend their budget in terms of how much they can spend in that market. And that's going to help that sub-$1 million price category, of course. And again, I should remind people that people in that first home buyers tend to be the most sensitive to these things. So, just even a small change can increase their budget by 10% or maybe even 20% with some of these things, because there's multiple things moving in the right direction. So they are really material, and we can't underestimate that. Now, let's talk about relative value, particularly in Melbourne. So let's compare sort of median apartment prices to median house prices, because I think that tells a bit of a story as well. So since 1980, so the last 45 years of data, on average, the median house price in Melbourne has been about 1.3 times the median apartment price. Now, just recently, that peaked out to about 1.64 times just during the COVID period. Houses did much better than apartments during that period, and it's since retreated to about 1.5 times. So still elevated, still above average. And the only reason it's come down from 1.64 to 1.5 times is just because since March 22, house prices have actually come off about 18%, according to the end of December 24, over that period of time. So it's not because apartments have actually, become cheaper. It's just houses have actually become cheaper. So I think house prices will and have started to recover in 25 already. So I think if you looked at those numbers, if you had real-time data today, they're going to be maybe about 1.6 times, still elevated above 1.3 times. Now, we can't get too caught up in the numbers because obviously these change over time, but I guess the key point here is that apartments look like relatively good value compared to houses in Melbourne, and Melbourne looks like relatively good value as a general comment. And the key point here is that the gap hasn't been this wide really for about 45 years. So, history tells a bit of a story. And we can see where the apartment market went, in the early sort of 2000s, the apartment market had a great run. And you can see that in the data as well, where the median house price ended up being about 1.15 times. So again, it's showing that there's a bit of mean reversion and relative value between houses and apartments in Melbourne. Now, it's important to say, okay, look, markets can be in the doldrum, and I've doldrums for a while, and then what happens subsequently, because it's very difficult to get a head around such significant price growth after we've been through such a prolonged flat period. But I've shared this analysis before in this podcast where I've got a few charts both with apartments and houses, which shows that the property market moves in cycles. There's a flat cycle followed by a growth cycle followed by a flat cycle, and so on and so forth. The growth cycles on average last 10 years. The flat cycles on average last 7 to 8 years. And so you put those two cycles together, a 17, 18-year period, and you end up with average growth of around 6 to 7%. And that's how the market works. So if you're unlucky to just invest just before a flat cycle, you really have to wait almost 2 decades to enjoy average returns. And that's how markets move. So if we look to Brisbane, because Brisbane's a good kind of case in point, if you like, between 2008 and 2021, that 13-year period, there was really no major change in apartment prices. In fact, if you factor in inflation, you would say that there's a real reduction in value and prices over that time. And the main reason for that was that there was a influx of supply. So they were building a lot of new apartments in Brisbane over that period of time. And those apartments were typically being sold to interstate investors, so people in Melbourne and Sydney, or overseas investors, Chinese buyers. And there were just too many apartments at that particular time, and that's why we didn't see any price growth. However, since March 21, the apartment market has really kicked off. So really between March 21 and December 24, the median apartment price in Brisbane has surged 60%. So it does demonstrate that even after a prolonged flat cycle, so we had 13 years in Brisbane, the subsequent couple of years has been a 60% growth, and I think that market will continue to grow. And I didn't actually look at or chart the median house versus median apartment growth, as I just sort of spoke about with Melbourne, but I think it would tell a similar story. So if we then apply that to Melbourne, like how does that compare to Melbourne's market? Well, if you just look at the raw data in terms of how flat it's been, really since 2017, the Real Estate Institute of Australia data suggests that's a 7-year cycle. But really my observation is don't forget that there's in that data where that's the sale of new apartments and also existing apartments. And so the sale of new apartments, I think, will make that data look a little bit better because they've been selling for prices higher than existing apartments. My observation really is that the growth that we've had about a 15-year flat cycle in Melbourne in the apartment market. It's really since the GFC that we really haven't seen that sector of the market provide much meaningful price growth. Maybe very low single digits, but nothing meaningful. And in fact, when you have a look at the median apartment data, it sort of confirms that. So between mid-09, so that's just after around the GFC time, to the end of 24, the median apartment price increased by about 3.1%, but inflation over that period of time was 2.7%. So less than 0.5% of real growth over that 15-year period, which is pretty terrible. And I would say most of that growth has probably come from the new sector rather than existing sector. Now, what does all that mean? Well, Brisbane had a 13-year flat cycle. We've had a 15-year flat cycle. With each subsequent year that passes, the probability that next year or the next 12 months will start entering into a growth cycle becomes higher and higher. So I don't know if the next 12 months is going to be better. I suspect as a result of all the things that I've spoken about today, in terms of supply of new apartments being contracted, the first home buyer stimulus, the lower interest rates, the stimulus around HEX or help debt, all these sorts of replacement costs being much higher, so it just costs too much to build new apartments. I think all these things are conspiring to generate and push the market into the next growth cycle. But, we just don't know if that's going to be this next 12 months or, in 2 years' time, who knows. But certainly it looks like we're on the precipice of another growth cycle. I'll leave you with just a story that I'd like to reshare. So Jared McCabe, who runs Wakeland Property Advisory and has a great podcast, there's a link on the blog on the website, discussed in a recent episode that he attended and followed the sale of a one-bedroom apartment in Hawthorn. They originally started quoting it at high 400s. They then revised the quote to low 500,000. The auction drew a crowd of about 60 people, and the one-bedroom apartment sold for 670,000. Now, it was a pretty special apartment. It's a good apartment, right? But this story stands out because I can't recall hearing a similar story in the last 10 or 15 years. So it's only one story, so we can't get too excited about it. But it's the first story like this about an apartment selling for more than expected that I've heard in about 15 years' time. So that could be signs that the market or sentiment around these sorts of property assets is changing. But I guess what I wanted to leave you with today was a bit of an update with respect to that market and then all the things that I think are going to stimulate this market moving forward. And it's been a long time since this market benefited from any good news, to be honest. Okay, let's get into some Q&A. First question is from Bob. Hi, my name is Bob. I'm a big fan of your Investopoly podcast. Listen to it every day on my commute. I really appreciate the data-driven approach combined with the qualitative insights. It's taught me a lot about investment principles. Thanks, Bob. I appreciate it. I want to get your thoughts on my property investment strategy. Here's my situation. I'm in my late 20s with an annual income of 115,000 plus super. I have $100,000 of savings. My parents will give me about $200,000 to contribute towards a property purchase. My current borrowing capacity is around $650, $750, so my total budget is capped at $1 million. I'm looking to purchase a property in mid to late 25 or early 26. And the goal of purchasing is to get the best post-tax capital growth over the next 5 to 10 years. I'm currently considering 3 options. Option 1 is buy an owner-occupied house in Sydney. Option 2 is buy an owner-occupied apartment in Sydney. And option 3 is buy a investment property in either Perth or Melbourne, or he's opened it up. Do you have any other ideas? And he sort of outlined the different pros and cons of kind of each option. So the first thing, Bob, is you certainly want the property to be owner-occupied, to my mind. That's going to put it well in front of any other alternates that's non-owner-occupied property. And the reason I say that, it's your first property, it's unlikely to be your forever home. And, if you do really well out of this particular acquisition, in 5 to 10 years, you've got the option to sell it and not pay any capital gains tax. And that opens up more options. Whereas if you've made some good gains, but then you have to pay capital gains tax, you lose sort of 20-ish% of that growth in tax. It makes those options to sell it, or the viability to sell it, less powerful. So the first thing I would be saying is prioritize nil CGT on the asset. So I would buy, I just finished today's episode about apartments in Melbourne. If you could work from home, I'd go and buy an apartment in Melbourne. I would come and live in Melbourne for 3 to 6 months, treat it as your primary residence, and then I would move back to Sydney. Well, I probably wouldn't move back to Sydney because I think Melbourne's better than Sydney, but I mean, if your girlfriend's in Sydney, then you probably should do that. But if that's not a possibility, then it's really a choice between a house or apartment in Sydney. I think with the sub-$1 million price limits or cap, I would buy an apartment. And the reason I would say that is because apartments have actually done really well in Sydney. I mean, if you have a look over the last 20 years, apartments in Sydney have done better than Brisbane or Melbourne, which is not saying much, right? Because in both those locations, apartments haven't done so well. But look, I would try and buy something in Sydney. It's going to be difficult, but I'd try and buy something in Sydney that has some sort of uniqueness. Now, you're probably not going to get a view, because that would be the perfect uniqueness in Sydney, to some sort of nice view. But look for some other attributes, something that's unique. So either it's in a really nice location, or a nice style block, maybe architectural wise. But you want to find something that is not generic. Whereas if you go for the house, you're going to be much further out, and it's going to be a very generic house, most likely in that budget. Because you said, look, spend $1 million on a home in Sydney, or option 2 was spend $800,000 on a villa unit or apartment. I'd actually spend $1 million on an apartment in Sydney. So go to your full price gap and then try and find something unique, like such a perfect location. If you can get something with a bit of a view, that's perfect. But some sort of uniqueness or attribute with a particular asset that's going to help its capital growth rate. And yes, houses tend to outperform apartments, but apartments in Sydney have done really well. And I think Sydney's always going to struggle with the density allocation, right? So if you've got an older style apartment block, at some point they're probably going to have to achieve more density, bulldoze that block and build something with much higher density. That really increases the underlying land value or benefit of the land value component. So occupy that property for 3 to 6 months, claim it as your main residence. You could always move back in with your girlfriend. Just from your perspective, maybe not necessarily hers, but to make sure that you're going to get the main residence exemption, you probably want to pay your girlfriend some rent. So to demonstrate that you're not de facto, you're not cohabitating together, because 2 de factos can only claim 1 main residence from a capital gains tax perspective. So if you're paying her rent, it's very clear that you're renting, and your principal place of residence, and the 6-year exemption applies to your current asset. Doesn't really help her, because it means if she's receiving rent, probably she'll put that in the tax return, and she's going to have to apportion her main residence exemption. But I'm only answering your question, not hers. Okay, it was a great question though, Bob. So thanks for submitting it. It's perfect timing, really, because of the topic that I talked about today. So just a reminder to register for that event, that YouTube event on the 28th of May. Link is in the show notes. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.